The following is an interview with Rick Segal. Rick Segal is director of Rethink Capital Partners, founder of C-Vest Investment Group, and advisor in over 20 different companies like Wireless Generation that exited for over $400 million and more. Rick got his start back in 1981, taking over his grandfather's family office and turned a $30 million fund into over $3 billion in assets under management today. He has almost 50 years of experience in M&A, going through many recessions and bull runs, and started doing deals before even calculators became widely accessible to the public. The key questions we focus on are: 1, what did the world of M&A look like when Rick started? 2, how has the game changed today? What are the key differences since he started? And 3, where does Rick see the future heading in the M&A world? And how would he position himself for those changes? Without further ado, let's dive into the interview. Enjoy.
Rick, welcome to the podcast. Excited to have you here. So I want to dive right in. You inherited your grandfather's investments back in 1981, and I think you were working at a money management firm for about 3 to 4 years. What I want to know, back when you started that early in your career, how did that early experience of managing your grandfather's family office basically influence your early approach to M&A for the rest of your career?
Yeah, I will go back and just say that, I was very young in 1981. I was even younger when I started, my professional career. That was in 1977. And during that time, I was working for a money management firm, but I was also being prepped by my grandfather on the investments, and we knew that the path would be that when he passed, it would be handed off to me. So it wasn't that I was coming at it, just out of the blue. I was definitely prepared. And the years that I spent working for somebody else, I still continued after I was running the family office. So I had two things going on, and I very much blended the career that I had built independently working for someone else with the activities in the family office.
100%. And what I would love to know is, what were the principles that your grandfather passed down to you that you've kept throughout your entire journey up to today? Obviously, even though it was you were prepared, what were the main things and principles he prepared you on that you talk about in your book as well?
I can really boil it down to a very quick statement that he said that I have never forgotten. It's not a good deal unless both sides think they got 51%. And I've always believed in that.
Oh, super interesting. And
I always got 49% as a result.
I'm curious, when you did take over the family office and to control the investments, to walk us through your earliest deal. What was your first deal like? What was that process like? And what were some of the lessons you had from that first ever deal?
Yeah, I worked very closely when I started. I was at a money management firm. This was in late 76, early 77. Very different times. There were not deals as we know them, but the firm wanted to bring deals to their clientele. You may remember that the stock market between 1967 and 1982 did nothing. The Dow crossed 1,000 in 67 and didn't see it until 82. High net worth individuals were not seeing the syndicated deals that they see now. Institutions were not even allowed to invest in those deals. We had the prudent man rules that said that foundations, pension plans, corporate investments could not be anything other than stocks and bonds. So it was really a bit of the Wild West, and the opportunities for off-market deals were quite many, but they were not nearly as sophisticated decks and all of that, because it wasn't a commercial operation. It was much more of a club, and it was much more, networking. Family offices, as a term, didn't really exist. There were a few, but it wasn't until the last 20 years that this idea of serving family offices even existed.
Super interesting. Could you walk me through what you mentioned, it being very different back then with less sophistication in the process? What did an actual...
I'll give you a couple of things. One, my first job, I had to go down every day and deliver a piece of paper to the man who owned our investment firm. And I had to give him a note saying how many shares had traded that day and how much the Dow had moved. On a good day, the Dow would move 8 points. And I had to say whether it was light, middle, or heavy trading. Heavy trading would be 15 million shares. Most days were around 6 or 7. We literally had the ticker tape in the office. That's how we tracked stocks. It's hard to believe, but that was in the 70s, and things changed so rapidly. Nobody knew the name Mike Bloomberg. He was just at Solomon Brothers. This is a time where things changed quite rapidly in a short period of time.
I can only imagine. I mean, so when you took over the investment firm and start doing acquisitions, what did that even look like, from the deal sourcing to actually analyzing the deal? I can only imagine, with today's technology and due diligence and all that stuff, what did a deal actually look like?
It's so strange, DJ, when you think about that. The first deal, believe it or not, that I ever did was assigned to me when I joined the management firm in, as I said, in the 70s. It was a deal that was created by Jack Black and Leon Levy, who are legendary for having run Oppenheimer and created deals. Here was the deal. They were buying a public company, Big Bear Supermarkets, Oppenheimer was putting up $1 million. They asked us if we would raise $1 million to match it. There was a leveraged buyout deal of a New York Stock Exchange company. We borrowed something on the order of 30 million with 2 million of equity, and Oppenheimer didn't have 2 million of equity. The world was so different. So that was actually the first deal I ever did. I was 21 or 22 years old, I did not have a business degree. I didn't have training. I had what I learned from my grandfather. And as I said, it was my first 2 weeks on the job. So I was going to night school to learn that stocks and bonds were two different instruments. So that's exactly what happened. And that deal ended up, turning out to be an excellent deal. And as a quirk of fate, a few years later, we brought that back to the public market, which was typical. And then by that time, I was much more engaged in the arena. And I joined a friend of mine in buying it back again. So I owned Big Bear Supermarkets twice in my first 15 years of a career.
Wow, I'd love to know, when you took over the firm originally, what was kind of the investment thesis, and what, had your grandfather built? And then based on some of the research I've done, I know that you made a lot of changes. What were some of the changes in strategy that you made?
You have to understand that I was 60 years younger than my grandfather. And he knew that he was passing on, aging out. And he knew that I knew nothing. So he had cleaned up a lot of deals that he had done and left a few. He also left. I can remember one day specifically. Most of what he left to me was maybe 20% deals, 40% bonds, and the rest in stock. And it was a total, back in those days, it was a total between I had 5 sisters, mother, and grandmother. It was a total of $30 million. One day he called me up furious because he realized that our position in IBM, which at that time was, even more prominent as the, solid rock that it has always been. But he said, how could you risk $500,000 in IBM stock? So, to say that I was on a short leash would be an understatement. And so, basically, we didn't have indexing, we didn't have ETFs, but I managed a portfolio that was of Fortune 500 stocks, a lot of the blue chips, the Nifty 50, that we had in those days, most of which lasted about 12 years, but those were the ones that everybody wanted to invest in. That was a good lesson, by the way. I always, realized that, and I've said it many times to people. Don't fall in love with a company, particularly a retail company. They all go out of business. But last year's Nifty 50 is going to be, next year's history. But we have this sense. It's a little hard now because we've got the Magnificent Seven or whatever we're counting, and those seem to be, dominant and irrepressible. But in those days, all of the money was going into stocks that everybody believed would be in business forever. So, we can go through the list of names, but, Sears and Roebuck, TWA. I mean, these were the names that were, that's what you had to invest in, to be sure. So it was, the world changed a lot. Remember, there was no such thing as a desktop computer. Apple was a baby. It wasn't public. I was there for the offering. So, it was a different world when I started. And in a way, I lost my grandfather as the world was changing. What I woke up to post 1982 was a roaring market. It was actually the Wall Street Journal had a frontline headline in 1982, "Death of Equities." That was the start of the bull market. The Dow was about 750. And they said, "Death of equities," and here we are today. So I've only been, 750 to 44,000. That's my career.
And I'm curious, what were the assumptions people made, especially during the bull market, about where the market was going back in the 80s that turned out to be wrong?
You have to remember that, when the 80s, came, we had gone through the Jimmy Carter presidency. We had gone through the gas crisis. The U.S. was in a weakened position because of the whole oil crisis. So we had stagflation. Interest rates were, short-term rates were 15, 16, 18%. People had no faith. I remember talking about would you buy a bond or a stock? And you'd buy a bond because you get your money back in 5 years, if you bought a stock, they hadn't moved in 15 years. So the whole view of the market was shifted. We had, people were jumping into energy stocks. Oil was deregulated and went from $8 to $44 in a weekend. We had seen silver and gold rise and crash. Those were the kinds of things that were happening, but there wasn't a real identifiable industrial movement. As I said, the computer was something that took up an entire room, and everybody thought that, that was going to be the realm of computers, that they would serve, big companies that could have a large refrigerated room. Nobody thought that not only would there ever be a desktop computer, but if you had one, what would you do with it? We used to spend all day, computing. I was actually, went to high school and college without a calculator. So we would spend all day trying to do a spreadsheet. It was very different. It wasn't until it was actually Mitch Kapoor that came up with the first spreadsheet. And then that was copied by Gates, and that was Excel. That was, 10 years after my career started. We didn't have word processors. We would sit down with a lawyer. You would talk, and they would take notes, and then overnight they would type, all night, whatever happened the next day. So, I don't know how we did it. We did business at, the speed of night, not the speed of light. So it was just very
On
strong.
that point of technology too, like in your book, Mindful Impact Investing, you have 10 pillars, and one of them I want to focus on is leveraging technology. And more specifically, obviously, everyone talks about AI and data nowadays. But I want to know, even today, from back in the 80s, what is a human skill, still in deal making, still in M&A, that's more valuable than ever right now?
Well, I think we know a few things. Anything in healthcare, those jobs will be there forever. There will be, it's funny because things like HVAC and, what's happening in M&A is the PE firms are consolidating those small businesses that they can power their business by using tools that we never dreamed of in the 80s, and software like Salesforce is, or more importantly for the smaller businesses. I was there, actually invested in the early days of Intuit, and coming up with QuickBooks. But that wasn't until the early 90s. A lot of those things are automated. AI is going to even make that simpler and faster, and lots of unbelievable advantages in almost every company that I deal with today, and I'm sure you see it too. Whether they're AI or not, they put AI in their name. Just like 10 years ago, everybody put blockchain in their name, whether they knew it, knew what it was or not. But we will not replace, certain jobs that need to be, on-site, hand-delivered, human interaction, and even when you look at medical, if you talk to doctors about, like a cancer, an oncologist about AI, AI absolutely can find cancers much better than any doctor. But you need to have the doctor to reaffirm the correctness of it. We all know, and maybe this will change, but AI does tend to hallucinate. And it's not at a place now where we can have life or death decisions made by AI, which is essentially a predictive mechanism. And we get confused by that. But it is not thinking on its own. It's taking all of the information that is out there, consolidated and bringing it to you in ways that we may not see the pattern, but once the pattern is laid out in front of us by AI, we need to observe that and act, use the human intelligence to intervene before we actually apply that in a case where, as I said, it might be a life and death decision.
Super interesting. I'd love to hear from your perspective as a deal maker who started before computers were around. You mentioned going to school without a calculator. What are some things like in your workflow day to day as an investor in 2025 that are drastically different from when you first started?
I'm going to tell you a funny story, and it's going to cover 40 years. When I was first on the street talking to investors, and these were what you would consider not family offices, but high net worth investors, I spent all of my first introductory meetings trying to explain to somebody what IRR was. What was an internal rate of return? It was a very hard concept. First of all, in those days, IRR, we think you can calculate it. You can't. What the computer does is interpolate just very quickly and figures out, you get closer and closer and closer, and then you find the number that when you use that as a discount, it makes $1 in the future, show a rate of return. So we were doing things by feel. One of the things that I've learned in managing a team of analysts, by the way, is I make sure to have a conversation, computers down, calculators down. What do you know intuitively? Because those of us, and I grew up on a slide rule, those of us that came from those times learned in our heads how to intuit what the answer would be, because that was what was required. And we knew a lot more, we had a better sense. We didn't rely on an instrument, which if we had made a typo or misentered a key and threw out an odd number, we would know instinctively a mistake had been made. And over the last 30 years, it's less and less that an individual analyst could find a mistake without, using a computer. And that makes it very hard to have a real world discussion about a company because you're not rooted in the understanding of the company itself. You're rooted in looking at it through a spreadsheet view. I was traveling in Japan with one of the, he was the number 2 guy at, drawing a blank, the firm that owned Chrysler, PE firm. And we were in Japan. And in Japan, we toured some offices. And they had offices where management met with no papers, no calculators. And he said, this is what we need to do back home, because I want to know before I talk to anybody that person has it all committed in their head. And we can think differently out of the box and imagine scenarios that can be ideated, not, subject to a printout. That you can't have that real free-flowing discussion if everyone doesn't have a sense of what the business is without looking at a spreadsheet. Maybe if you have different muscles today, it works differently. But for us, we had to intellectually understand everything because we couldn't rely on tools that may not be precise enough.
Right. That brings me to actually one of the pillars in your book, which is there a compelling origin story? Like when you're looking at a company, is that one, like, talk to me about that pillar and like the intuitive element to that when you're kind of, I guess, analyzing a founder's origin story. Like, talk to me about that.
Well, entrepreneurism, particularly over the last 20 years, has gotten to be so romanticized. When I was growing up, nobody planned to be an entrepreneur and then find a company. Somebody had an idea and then became an entrepreneur. We've gotten into a culture just like, it used to be that you were a celebrity because you were important, not you were important because you were a celebrity. So we've gotten a lot of entrepreneurs that think that this is an easy path. It's not. And if there isn't a story that ties the entrepreneur to the project, either some issue that he's dealt with in his family or some commitment to some order of change that he believes will fundamentally change the world, you don't have the commitment, the internal commitment to take that journey. If you think about Steve Jobs, he was totally committed. He lived for Apple. He had a vision, and everything he did was within that vision. He had, was thrown out of the company for a couple of times because people didn't understand how committed he was to that vision, but ultimately his vision for Apple is what changed the world. So you need to, this comes from, Malcolm Gladwell, 10,000 hours. If somebody hasn't committed the 10,000 hours to what it is that they're going to do, they haven't shown that level of understanding, that level of commitment, and that level of expertise, then it's easy for them to give up when things get tough, and they always get tough. FedEx was just becoming a thing when I went to Wall Street. Fred Smith is, famously, we know, got like a C- on the FedEx, a business plan that he submitted to his college professor. They went through 5 rounds of funding. Almost all of the funders dropped out until they finally turned the corner in, the E round or the F round or something like that. This is the kind of belief that you have to have, the commitment you have to have. And I've also grown up in parallel, as you probably have a whiff of, in the art world. And I know what it means for an artist to be committed to their craft and to spend 40 years drawing the same thing, trying to get more and more perfect, and living a life pursuing a goal like that. We need to have in the entrepreneur, as I said, not an entrepreneur who's seeking to, make $1 billion and retire. You should, bet on the crypto market if that's your goal. But if you're going to take people's money and build a company, you better be committed to the idea, and to the idea that it's going to take a long time. We went through the period, the dot-com boom bust, where you had an idea and an IPO 18 months later. Now it's 18 years later. You can't give something over to somebody expecting a quick who's expecting a quick return. It's a tough path, and you're going to live in your 40s like you lived when you were 22, sleeping on your parents' couch and not having the ability to raise a family on, you haven't hit the big time and you're still there slogging it out 20 hours a day. It's a really hard path.
That brings me to I would love to pick your brain on your thought process about investing in established companies, which is, it sounds like where you started. And I think now you guys have a venture arm. Like, how are you thinking about evaluating an entrepreneur who's kind of at the idea stage versus a more established business?
You're asking me, questions that have changed, organically over time. In the last couple of years, it's been an advantage to buy into existing companies because, the formula for building a business is, pre-seed, seed, A, B, C, and they are all based on the principle that you will hit certain milestones and then you will find new investors to come in at a higher and higher valuation. And that leaves management with significant ownership of the company. If they raise the money that they needed to build a company up front, they would end up being diluted out of an ownership position. It's very important to have management vested, not only emotionally, but monetarily in the business. But in the last few years, as companies were unable to raise a B round or a C round, and they were running out of capital, and we lost, and I talked a little bit about this in the book, we lost Silicon Valley Bank, we lost PacWest, we lost First Republic, we lost all of the traditional places that lent to equity firms that were building. There was no access to capital. Then when we started getting to interest rates that were not, close to negative, we also lost a lot of people willing to take the risk, because there wasn't an advantage to getting investing capital. As I said, my grandfather left me with a large bond portfolio, earning, maybe 8 or 9% U.S. Treasuries. They were U.S. Treasuries, where you were getting a negative return for many years. So it drove a lot of people to invest. When that turned upside down, we had the reverse yield curve, all of that. It became capital was withdrawn from the market. Also, venture firms started raising, the first venture firms were raising $100,000. Now, they're raising $10 billion. Just like in the stock market, those firms that are managing large amounts of capital can't invest in public companies that are, on the small end, because there's no room for them to make that investment for as many billions as they're trying to invest. Same thing is happening in the venture world, where these venture firms, unless they're doing what some of them do, spray and pray to, put out 250,000 to $1 million all over the place and then wait for one of them to, poke its head up and then pile in. Unless you do that, there's no way you can manage a portfolio where you're putting less than 10, 20, 50 million. If you go to Bain Double Impact, for instance, a great firm for the impact space, that's a $50 million minimum check. That's not really going to help with somebody who is bringing forth the new technology that can do things better, faster, different. So we're reliant on those of us that are willing to get involved at early stages, or as I said, in the last few years, come into a situation where a company has bumped up against the capital need and needs to do maybe a down round or some other, participating preferred, 2 times preference, lots of bells and whistles to encourage capital to come in. And those opportunities are out there, and they're out there in $1 million, $5 million, $10 million pieces, because you've got a company that really does have cash flow, does have growth, product market fit, all of those things that we look for, that we used to a few years ago have to pay up for an idea, not for a company that actually had proof point to validity of their business.
And you alluded to it there, but when it comes to venture or buying an established company, from what you've learned across the last 40 years, the key moats that you've looked at in a company before investing in it, and which ones have turned out to be the biggest and best moats you've seen?
Yeah, I would say, you use the word moat. That's the most important thing. We do know, and IBM and Apple have proved that whatever you think you have a moat with IP, you don't. There's so many ways. So you really want differentiation. You want skill within the management group, the ability to do something and do it really well and continue to evolve and stay ahead of the curve. And so I don't think you can build a moat in that you're ever going to keep out the competition, but you can build the intellectual moat that you've got the team that will continue to pivot or ideate, expand their vision faster than anybody else can catch up to it. But it has to be a core vision at the beginning. The iPhone doesn't exist without, the first Macintosh. So they were able to, they don't even call themselves a computer company anymore. It's consumer goods. But they started with, something in the garage to do simple calculations and kept staying ahead of the curve, whether it was going, design or retail or figuring out that people didn't want, the 10th best use for a phone was a phone call. I mean, these are the kinds of things that you look for.
And in that capacity, then, obviously with AI now, how should an investor approach a company, investing in a company?
I'm glad you raised.
Buying a company with like an AI IP, how should people approach that now for the future?
AI is obviously a buzzword, and it's a broad word. There are many people, in fact, it's funny, but San Francisco is being revitalized. We wrote it off 2 years ago, and now it's revitalized because everybody who's got a college degree is rushing to get to California and work for an AI company. The AI is it's a very sophisticated process. Each one of those platforms has a certain strength. We've invested in an AI company, which I won't describe now because it would take a lot of time, and we're already over time. But they don't build it off of one iteration of AI. There are 8 different versions of AI, and each has their own strength. And unless you have a team that is very, very sophisticated and didn't just show up 2 years ago, but has been working for the last 15 years, that's the other thing we don't recognize about AI. It's in the public mind now, but it's been in the computer science world for 20 years. And we need to rely on people that understand it at a very granular level and understand small differentiations between the platforms that are available and put them to use in the best way that they can, and knowing the unique functionality of each one. So it is taking advantage of the best product from the best minds, not somebody who flashed, onto the scene and went onto ChatGPT and said, I'm an AI company.
Right. And it really can be a buzzword, but like I'm curious just on a like while we're on the topic, like with all the hype around it, what industries do you fundamentally believe are going to be the most impacted by it when you look at it from a larger scale?
You asked a question earlier that I will relate to, which was, what are the jobs of humans that aren't going to disappear? One of the real great uses of AI is that, let me just imagine something for you. I'm a psychologist, and I've got you as a patient, and you come in every week, and I've got to be taking notes, and I've got to be trying to remember what you told me a month ago or a year ago. And I've got to listen to you empathetically, and I've got to watch your tone of voice, and I have to look at your eyes. I have to know your reactions. My mind is going all over the place. AI can record every session. It can comment on tone. It can comment on visualization of any facial reaction. It will take all of the notes. At the same time, it will remind me as the physician that you told me about a trauma, a family trauma you had 15 years ago where your aunt did this or your uncle did that. And it will shoot me a clause. You've heard this before, Rick, remember. And then I, in real time, can relate back to the patient. These are the ways that AI can truly be, world changing. Human interaction where we do not have the capacity, just like I was talking about reading a X-ray, we don't have the capacity to multitask, to recognize patterns. But if we have AI, and that can affect the way we're understanding patterns and give us the ability to see them in a way that is beyond our physical capacity, not let alone our mental capacity, that's the most helpful.
Through the lens of impact investing in AI, do you have any fears about, I guess there's a lot of talk about potential negative impacts of AI. What is your thought process on where AI is going to go in the future and whether it's going to have like a net positive or net negative impact on humanity?
I think that you asked the question that is on everybody's mind, and I was talking to somebody in the space about this. AI is trained to teach itself, and I mean, I grew up when 2001: A Space Odyssey, 25 years in the future, and Hal was taking over, the world, and that was the whole point of it, that computers and AI would be our enemy and not our friend. I think that a lot of it has to do with how we program AI and how we, maintain some restrictions about its use case and its development. I was talking to somebody about, we have no problem feeding in contemporary writers, contemporary songs, all of that. What we need to do is program AI with some of the 1,000-year-old metrics that, whether it's Christianity, Buddhism, Islam, the Jewish religion, we need to program AI into that so that we can develop a fundamental backstop for how AI thinks. Just like we've spent 5,000 years developing a civilization where we have incorporated all of those lessons. The only reason we're born with values is because our parents had values and our grandparents had values. We need to make AI as informed about how you create values as they are about how you copy a Stephen King novel. So I know that that's not a very, that's fantasy, but it just, overall as a metaphor, I think we need to have the consciousness to understand that we need to take some of our conventional wisdom and program that into AI from the start, so at least it develops with the same level of awareness that we as humans, and not that we've done a great job of it, but we've improved a lot. But some of that, empathy, understanding, compassion, that only comes because we rely on the lessons that we've learned from our ancestors that have been tried and true and tested by civilization year after year after year.
And one of the last questions to me I'm just genuinely curious about is, on a separate note, you've done a lot of cross-border acquisitions, I think with Rethink Capital Partners, one of your companies. You've invested in companies, it seems like, in the UK, France, Israel, India, etc. What are some countries you see up and coming and economies that are going to grow, you think, over the next 10, 20 years?
Well, it's funny. I think we all know that from a global perspective, China is going to do that. But, when you invest in those companies, it's, one, there's a lot of restrictions about moving capital back and forth. Two, obviously, as in the case of China, there's a lot of risk of stealing IP and you can't control it. I served for many years on the board of the Africa Center in New York City. The African continent, which China is way ahead of us in, understanding and, exploiting. There's a lot that's going to come out of Africa. It's got the youngest population in the world in terms of, the age of the people on the continent. There is a lot of untapped intellect that is slowly coming together. I think that's one of the dangers of our current immigration system, that we're not, one of the things you've seen me say is that investors need to invest where other investors aren't going. We've been very early on investing in women, and they've been receiving 2% of the capital. That doesn't mean that they're any more or less at risk, but it means you're not fishing in the same pond as everybody else. Africa is, Nigeria, Lagos is going to be the largest city in the world in 15 years. We need to think about the future in that way. And what we've seen is when China breaks out and develops a middle class, when India breaks out and develops a middle class, and then when Africa does that, these are where, globally, the layers of growth come from. Our population is stagnant. And now that we're not letting any people in, and we're losing our scientists outbound, we need to very carefully look elsewhere. Israel is interesting because they have as a culture, entrepreneurship in a way that no other country, is all in on. And they have great universities, they have great minds. But that may change. But that's today. If you're talking about today, we can be looking at Israel. We can be looking at India. If you're talking about tomorrow, I think we need to look at Africa.
That's fascinating. I know we're coming up on time here. I've got one that I'd like to wrap
Sure.
it up with. So if you were advising kind of a younger investor today who hasn't had the luxury of, investing in markets for multiple decades and seeing multiple market cycles and seeing technology evolve from the 70s, 80s, all the way to today, what's kind of like the mental model and framework that you would advise them to look at investments in 2025, as we move into the future?
I think that somebody, today has a huge advantage in that they're digital natives. And they have a huge understanding that is embedded in a way that those of us that had to, evolve don't have. But always rely on a mentor. Always rely on somebody who has gone through market cycles. We unfortunately, as I started out, we don't have people anymore that remember that in one day, 25% of the value of the market was eliminated. They haven't seen that happen since 1988. So I would say you should use what you know and what you have the luxury of understanding in a probably more in-depth way than the older generation. But as always, rely, and it's the hardest thing to say to somebody young, rely on what your elders can tell you. You don't have to follow every word, but you have to listen and appreciate where it's coming from and incorporate that into your thoughts. And don't ever invest. You can only invest if you're scared of losing money. You cannot invest if you don't see the dangers. And you won't see the dangers unless you talk to somebody who's made every mistake and seen everything go wrong that can possibly go wrong.
Wonderful advice. There we are, gentlemen.
Hey, this has been fun.
I think that's a wrap.
Right.
Yeah, absolutely.
Thank you both.
Kieran, I think you
Yeah,
can wrap
thank
it.
you for coming on, Rick. It's been a pleasure, and it's been amazing.